Meanwhile, also keeping a very good eye on what's happening at the corner of Wall and Broad with the Dow teasing a record or about 160 points or so away from one. The S&P isn't that far away as well. And all of this in the face of higher interest rates, which you'd normally say, wait a minute, that doesn't make sense. But it's helping financial shares, helping big bank shares and all the rest. And all this uncertainty around Judge Kavanaugh, all this uncertainty around trade. Well, it's not adding to any angst in the financial community. They're buying, thinking that this too shall pass. Will it? Let's go to Fox Business's Susan Lee, Fox News contributor John Layfield, and EventShares Chief Investment Officer Ben Phillips. Ben, what is driving this? That everything else you would think that the markets are out of touch, or maybe they're just accurate.
Yeah, I mean, I think you're seeing such strong U.S. growth where people are looking through this trade dispute right now. You know, we still think it's the biggest risk, but you're seeing a strong consumer. You're seeing just strong GDP growth. You're seeing strong industrial activity. You know, the only thing we're seeing is a little bit pullback in imports. So that was something we watched in August. So we're a little concerned about that. And you were saying it's not giving the market angst. It's certainly giving me angst. Right. You know, someone as a portfolio manager who's trying to, determine where the market's going. It keeps going higher and higher.
Well, what do you tell investors who look at this and say, don't worry, obviously we can be happy?
Well, we say watch trade very closally. We don't say
trade is the bigger issue.
Trade is the biggest issue for markets. It's the biggest risk for markets, too, in our opinion.
Is it still, John?
Yes, it is. Look, I worry also about the trade policy. I think it's not a very thought-through policy, but you're talking about a very small percentage. So we imported last year about $2.9 trillion. When you add the $200 billion of extra tariffs at 10%, you're still talking less than 10% of total imports, which is a fraction of total GDP. So you got a fraction of a fraction. This is not that big right now. It could escalate that as a concern, but right now the market's looking at it as this is not a big deal.
You know, Susan, I know you lived out there and can attest to the mood in China. When China's number two, the premier goes on record saying, yeah, we're getting a little worried. I'm paraphrasing here. Is that a preview to blinking?
I feel like it's conciliatory, yes. So that's what I heard last night at the World Economic Forum in Tianjin. I think that's actually helping boost the enthusiasm out here in stocks as well. And shouldn't we all be encouraged that there's a rotation taking place? You know, all the names of the technology sector that took all the gains for the year, there's a rotation out of them. Now we're getting into dividend payers, yields like telecoms, utilities. And when you have more breadth in the market, I think that those gains are more sustainable. So I'm encouraged, actually.
Yeah, that's actually interesting because the Apples, the Alphabets, the Amazons, they're the ones, who are, sucking wind in September. All these other boring names, or that we call them boring because they're not that flashy, are the ones carrying the load.
That's right. Yeah, and we've been investing in the boring names, and that's where we're actually finding the opportunities.
That's where I live.
The PLC-wide portfolio, I think, is almost 25% healthcare. Sorry, 21% healthcare.
Is that right?
Yeah, and that's been really, and it's still ACA tailwind. I mean, this is a long-term policy tailwind. Tax reform is the next big one. We're only in the first year of tax reform, so that's driving stocks in the portfolio.
And yields are back up at 3%. Banks are having their best day in 2 months. So financials are back in vogue.
Financials are starting. They haven't had the best, or at least our financials haven't had the best year, but they're starting to pick up, and especially the non-traditional lenders, the ones seeing the deregulation from CFPB, they're seeing the biggest tailwind.
You mentioned the financials. I had Sheila Bair, of course, the former FDIC head, and she was saying, I was talking to her during the meltdown 10 years ago this week, her concern then is the same as it is now, oddly enough. Don't let these guys get away with murder. However better capitalized they are, they're not ready, and we shouldn't be ready to rescue them if they're not ready. What did you make of that?
I think they're still too big to fail, and I don't think anything. I don't think anything's changed. I don't think Dodd-Frank changed much at all.
Citi or Bank of America were pushed into the corner. We wouldn't let them go.
We did nothing to stop the next financial crisis. We put some restrictions on these banks. We put on some reserve ratios on these banks, but we didn't deal with the problem of derivatives
and by the way,
sold.
All that extra capital wouldn't save you if in the middle of a meltdown.
Well, if you look at JPM, they have $2.5 trillion of assets under management. In 2007, that was 1.3 trillion, which was called an impenetrable, by the way, balance sheet by J.P. Morgan and Jamie Dimon back then. So, yeah, the banks are much bigger now, so maybe they're even bigger, too.
There were days 10 years ago where we would lose $5 trillion in market value in the financials alone on a day.
These guys were the ones in charge at the time, and you asked them to fix it. I mean, they're the ones who didn't see it. So it's impossible for them to fix it. They're talking about derivatives of derivatives. They don't understand this. Few people in the world did. The entire market got leveraged to it. Dodd and Frank missed it. Then you put Dodd-Frank in charge to fix it, and they didn't fix it.
Well, they would argue we're in the era of living wills, stress tests. So wouldn't you say the bank and the banking system is a little bit safer than 2008?
Yeah, but to John's point, where did it transfer? All that risk went from the private sector to the public sector balance sheet. So it's not like we've seen a real de-risking of the global economy.
We've
just moved it.
We patched debt problem with debt, right? And does that worry you?
$3.5 trillion in debt.
Do you worry about that, how it looks for your generation?
Absolutely. Debt is just really pulling forward future consumption. So it's, that's the biggest risk to,
So how do you play that? I know they said, well, what happened 10 years ago won't happen again. But we get variations of different crashes at different times. What would be the next thing you worry about?
I worry about a bond market blow up, potentially. I worry about a questioning of governments and sovereigns' balance sheets, even the U.S., when our debt gets so high relative to, even if you look at GDP, people have issue with that.
Right.
But you look at our leverage as an economy in the U.S. now, it is unsustainable, and it's growing at an unsustainable clip as we get to $1 trillion deficits.
See, I'm okay with that because I think I'll dodge a bullet just age-wise. These two are boring, but I don't really care. But is it I'm kidding, but is it your sense that this is an imminent issue, John?
I don't think it's an imminent issue, but it's an issue because there's no difference between these guys. The debt doubled under President Bush, it doubled under President Obama, and now we're back to $1 trillion. There's no difference in fiscal responsibility between
and no
Republicans
concern on
and
either
Democrats.
party to address it.
None whatsoever. Everybody is kicking the can further down the road, and I think at some point it's not imminent. But I think we have a real problem right now with if inflation were to kick in, rates have to go up. We could be a real problem with our government.
The president says you can grow out of it.
Well, you would have to grow out of it because all that debt, right, is basically like an interest rate hike added on to the Federal Reserve's
The Fed's going from $3.5 trillion, and now they're going to ramp up next month to $600 billion annual run rate.
Right.
It's going to take 5 years for them to take that balance sheet back to a normal level, at least. And what are they going to do if we hit a crisis in the next year?
And whoever the economy is going on a good clip, moot point. That's what the president's saying.
Let's see where the economy is in a year or two. We're going to have a pullback here at some point.
Make a final point there.
The point is that no politician can take out $1 trillion out of the economy and get reelected, and that's the issue. You take $1 trillion out that they're spending in government funding, which is some of the best funding out there as far as people's jobs.
$1 trillion is chump change these days.